Good morning, good afternoon, and welcome everyone to this Financial Inclusion Week session on getting pricing right, sustainability and incentives in digital public infrastructure. We'll focus today really on pricing strategies and pricing considerations in instant payments. My name is Eduardo Totolo. I'm the Deputy Managing Director at the Center for Financial Inclusion. I'll be the moderator for this session and really excited about the conversations that we're about to have. Um, Today, we want to focus on one of the key tensions, really one of the key trade-offs in the context of digital public infrastructure, which is about the long-term sustainability. The question really is, how do we ensure that DPI, and in particular, the DPI layer of instant payments remains accessible, affordable for lower income segments, for small businesses, while remaining financially viable over the long term, providing the right incentives to private sector players to invest, to innovate, to be a core part of the ecosystem. Um, we have two simple questions, well, simple to describe and not simple to answer in today's session. One is a descriptive question. Who is currently paying for instant payments in the systems that are active now? Who is currently paying for them? We know instant payments are not free, but someone is bearing the cost. Who is currently paying for them? The second question is a more normative one. Who should pay for instant payments in the future as we think about the long-term sustainability of these critical pieces of infrastructure for the digital economies? Who should pay in the long term? We all know about some of the very successful examples coming from India, UPI, from Brazil, PIX. They've really transformed how people, businesses move money around. Uh, Payments are seamless, they're fast, they're free to the consumers and merchants to a large extent. Uh, this question on pricing may sound technical to some extent, but it has real consequences. It has real policy implication. It affects whether all players, from smaller players, fintechs, smaller to mid-sized banks, to the large incumbents, have, it determines what incentives they have to compete, to be part of the ecosystem, and it determines the sustainability over the long run. Um, we only have 45 minutes. Is a big, I think, topic, and I'm really excited to have some outstanding speakers today to answer some of these questions. Let me start with David Porteous from Integral Solutions. He's a longtime thinker, researcher, leader in the financial inclusion space, and also in recent years has done a lot of work on digital public infrastructure, advising some of the leading institutions in the space. Welcome, David. It's great to have you here. We have Nancy Imadi, Head of Policy for FinTech Innovation at the Central Bank of Ghana, who brings experience on how pricing and sustainability debates play out in real markets in Ghana, but also giving us a broader perspective. And finally, Raza Matin from the Better Than Cash Alliance, who has an incredible background working for Google, working for different startups and banks, and now leading the policy work for Pakistan at the Cash Alliance. And recently, Raza and his team have published a very, very interesting study, one of the most detailed studies on pricing considerations, looking at the RAST system, the payment system. So that is the instant payment system in Pakistan, looking at the pricing strategies and the dilemmas that are emerging. So really excited. If you haven't seen the study, I strongly recommend putting it in the chat and looking at it. This is an overview of the speakers. We'll get just starting a discussion, and I would like to start with you, David. You have worked in recent months to do a landscape study mapping out how instant payments around the world are structured, how they work, pricing being the main consideration, but really looking at other components as well around governance, around mandating of participation. Can you tell us more about your findings so far and set a bit the context, and then we'll get into provide the context for the country case studies from Pakistan and Ghana that we'll discuss later on.
Sure, I'd be happy to do that, Eduardo. So thank you for the opportunity to at least share some headlines from that research that you've referred to. And thanks also to the DPI Insights community, which has supported the research. So, Eduardo, to answer this question of who does pay requires some framing. So thinking of that question of framing, we hear from the BIS that there are now more than 100 instant payment systems live around the world. And in fact, the most recent one to be born, the newborn on the block, is in fact Colombia's Brebe scheme that was launched last month, in fact. And to your point about the complexity, that pricing is never a single dimension, it's linked to others. Brebe has these three characteristics, just to use it as a case in point. The first is it's owned and operated by the central bank. The second is participation of banks and other financial institutions is mandated. And then the third, directly to the conversation today, pricing to consumer is mandated, and it's mandated to be free. Now, it turns out that that newborn on the block, in fact, follows its bigger cousin that you've already mentioned, Pix in Brazil, the big player in Latin America and even global payments. It has exactly those same three characteristics. And if we extend it even further back from Pix, Pix itself in some ways picks up some of the footprint, the characteristics of UPI, which is the granddaddy of instant payments worldwide today, by far the biggest scheme in terms of volume. Not exactly the same, because as you point out, there's a lot of complexity here. But there seems to be this similarity. And so part of the research question was to try and generalize that beyond these three schemes, look at a sample of 26 around the world, including, in fact, Pakistan, Rast, and Ghana's instant payment system that we'll hear more about today. And indeed, Eduardo, it does seem like those three characteristics are increasingly more common. So 2/3 of the newer schemes launched in the last 10 years, tend to be owned and operated by a central bank. Participation by banks and others is typically mandated, and it's also more common that pricing is mandated. But that quickly gets complex, because mandated by whom? By a regulator, by the scheme itself. And the mandate is not always for free. We have recent examples of payment schemes where the mandate is actually to charge a fee, but it's a specified fee. But it does feel like the first answer to this question of who does pay is increasingly not the consumer, because of those mandates, which include in many cases free. But of course, we know from cost of cash studies and things that were done a lot 10, 15 years ago, that even cash, it's never free, even though there are no fees. There are costs to using cash, getting it. There's the risk of theft of cash. And so even with digital and instant digital payments, it's never free. Even if there are no fees, there are costs, not travel perhaps, but risk of, for example, fraud, which is a rising situation in many parts of the world. So if it's not generally consumers who pays, who does pay? Well, in a number of schemes, merchants do, but then there are schemes like UPI, where in fact that was ruled out largely, again, complexity there, but in 2020, and instead a subsidy scheme covers part of the cost on a year-to-year basis. In the main, though, it seems like those who pay today for schemes are central banks themselves. When they own and operate them, they pay to set them up. So we know that Pix cost the Central Bank of Brazil $3 to $4 million to set up. That seems pretty cheap. In fact, they say they did it on the cheap relative to what would generally cost to set up a scheme like that. And then they say it cost them $10 million a year to operate Pix, which again, as a per transaction cost, is in fact really small. It's like 1/100th of a US cent to operate Pix today. So central banks incurring part of the cost, but we know in these schemes, the scheme costs are only one part. They're always the participant costs. And that's where it seems like the main burden of costs has generally sat, especially in environments that have had relatively low levels of acquiring or participation, and where there's been a need to recruit new users. So India, a case in point, where a lot of the acquiring has been done by these third-party application providers, Google Pay, PhonePe, the likes of them, who've been funded largely by venture capital, by private equity. It's been private money that has funded this type of ontake of new customers on very large scale today. So that's who does pay, very broadly speaking, in terms of those trends, which are interwoven between who owns and who sets and who has to pay. Who should pay? Well, again, it depends, I guess, on what you're looking to achieve. And this is where it feels like there are at least three possible answers. And sometimes those answers seem to be woven together in ways that create a slightly unstable mix. So one answer could be make the answer of who should pay based on ability to pay. So especially low-income consumers, they can't afford to pay. So rather let For example, banks pay. They can finance schemes. Central banks can finance schemes, as we heard increasingly they do, where they own and operate them. So that's one basis of who should pay. The second answer could be according to who benefits, who gets the benefits. And often that's framed as being banks get the benefits, both because it reduces cash handling costs, which are quite substantial. Banks carry the bulk of cash handling costs in many countries today. Also, because banks benefit from the cross-sell, which comes from this larger pie of customers, if you like, using more transactions and open to more services. Now, the difficulty with that is, of course, that the banks who might have to acquire the customers may not be those who benefit from the cross-sell. And in fact, some of the capital markets seem to be telling us that message, because in countries like Brazil today, new disruptive digital banks like Nubank are valued with multiples 4 times the multiples of the Brazilian banking sector as a whole. And in India, the same thing for some of the, call them digital disruptors, which are still loss-making today. You know, the likes of Paytm, even PhonePe, but are valued substantially more highly than banks on average today. So that cross-sell question is still a complex question within banks as to who pays and who, therefore, who should pay in future. And then lastly, of course, there could be a mix of strategic considerations, for example, to reduce the use of cash or to promote financial inclusion or digitalization. But I think the real point here is that according to which of those is prioritized, you end up with a slightly different answer. For example, if it's about financial inclusion, then acquiring new customers is really what's important. Whereas if it's about driving out cash, you have to look at where the big cash pools are, probably with merchants, and look at the incentives to particularly get them to want to accept cash payments. So what I'd say, the answer of who should pay is a complex one. And that's where it really leads to, I think, the headline point for me from looking at these examples is simply to say the pricing of IPS can never be a recipe. It should not be a recipe. It has to be something which is rooted in the incentives of the payment ecosystem in a particular environment. It should be something that's dynamic and evolutionary because it's a complex system that's changing over time. And if there is not effort made to update and to revise and refresh on an evidence basis what's going on, then I think the incentives are likely to run skew. And some of these 100 schemes we see around the world are not going to reach the success of the granddaddy we've referred to, UPI, and others. And even with UPI itself, pricing questions continue in India to be profound to this day. So let me pause there and look forward to hearing more from the countries themselves.
Thank you, David. That's a really powerful framing for the conversation. And to me, a few points come out very strongly. I'll be keen also to get Raza and Nancy to kind of think about and elaborate on. First of all, is quite striking how different the landscape of instant payment looks today compared to a decade ago before Granddaddy. You can almost define a point in time, like a pre-UPI instant payment system ecosystem and a post-UPI, which of course has kind of set a model that many others are trying to replicate. But the evolution of that is that instant payment seems to be evolving in the governance and core structure, increasingly being mandated, increasingly free to the consumers and the merchants, are almost free, and increasingly publicly driven. Some of the questions that emerged to me, and I'd love others to kind of to weigh in on, is like, what does that do on the private sector, not just on the larger banks, because indeed some of the larger banks may be able to cross-sell, they may be able to benefit from the economies of scale, but to the smaller players, to the newer fintechs that do not have that a large footprint within the economy. What happens to them? And then finally, another point. There's no recipe. Very interesting. And that actually goes into some of the debates that we're having around digital public infrastructure, which is, on the one hand, there are benefits to standardization. And on the other hand, as we see about each country having a very different context and really needing different solutions. So to what extent, maybe there's another trade-off. Again, we've been talking about trade-offs in DPI a lot. That may be another one that we may consider more. But I would like to take that now to a real country context. I'm moving on to you, Nancy. Ghana has been one of really of the early movers, and I think it's not a story that is told enough in our sector about how early Ghana was in introducing and revising the system of interoperable payments, with both public actors and private actors playing a role. Yet, as David hinted, when systems are made free to end users, the costs do not disappear. They're still there, just someone else has to bear them. Um, from your experience, from experience as a regulator, but also as a leading thinker in this space, can you tell us more about give us an overview about the Ghana system of instant payments, and also how is the regulator thinking, and how has it been thinking about long-term sustainability, with pricing being one of the components?
Well, thank you so much, Eduardo. Of course, David as well. And then as also on the call, I think I mean, the deposition given by David is quite excellent. And I'll just sit in here listening to him and just nodding my head in appreciation. I mean, a lot of the times we policymakers or regulators, we tend to be more fixated with our everyday work desktop. And so when we are able to see it as it plays out in research and outcomes such as what David has put out, is quite exciting to hear as well. And of course, Eduardo, you're absolutely right. The journey of Ghana has been one that has been ongoing for quite some time. I can tell you for a fact that we have been at this process since about 2003, when we promulgated the first Payment Systems and Services Act. And of course, to have a digital public infrastructure, there's so many components of it, right? We're looking at how you're going to identify people. How do we know who people are, right? What do you use to show who you are? Beyond that, how are you able to make instant payments? And then hopefully, thirdly, we should be able to exchange data so that you'll be able to access services, whether it's public services from government, from private, whichever way, that individual or that citizen should be able to do that as well. And so you would see that it is not a one-stop shop, or it doesn't come about as a result of just one single act. It comes together as a result of different milestones, different activities, intentional policy-driven, activities culminating together for us to get to that point. And in Ghana, we've had very, very significant, activities that we've been intentional about to get us to where we are today. And so you see that even from 2003 up to 2007, when we actually set out GIBS, the Ghana Interbank Payment Systems and Settlement Platform, to be able to offer interoperability for the payment ecosystem, it has stemmed out of years of intentional policy-driven direction. And then it also starts from the national tone. What does a government want to do? And we also had that cash light agenda by a government. And so you would see that the intentional policies to, push us to that direction as well. And then, of course, in 2008, we moved ahead and, moved into branchless banking guidelines, also to open up the ecosystem for us to lead to that space. And then in 2009, when we actually brought out mobile money to complement the work that had already been done in the past, all the way up to the point where we came into 2018, 2019 to establish the revised Payment Systems and Services Act 2019, and then even into the intentional establishment of the FinTech and Innovation Office in 2009 by the central bank at the time. And so you would see that there's been, intentional efforts for us to get to this point as well. And then I would also say that being able to offer interoperability platform or a digital public infrastructure to enable payments, it also stems from the tone of any regulator as well. And so you would see that at the Central Bank of Ghana, it was an intentional effort. And you would know, whilst David was speaking and asking about, how the models of various DBIs are deployed in different countries, he mentioned one and he says that owned and operated by the central bank. And for the model in Ghana, that's what we have. So it's wholly owned by the central bank. And so you will see that initial investment, that initial cost is borne by the central bank. And then we have that participation, which is mandated of financial institutions to come on board. And then you will see ecosystem players such as electronic money issuers, payment service providers being able to participate on the platform. And then the model that is also operated on GIBS, you would see that where there is a sender, it doesn't come at a fee to that sending institution, but it is the receiving institution that has to bear the fees of operating on the platform. And so you would know that the pricing model going down to the consumer, what does that translate into? There's an initial cost, investment cost that has been absorbed by the central bank. And so the participation cost for that receiving institution is also lower. And then what is eventually passed off to the consumer becomes lower, because also you know that our motivation is also for financial inclusion. And we have so many people who are beyond, excluded, beyond the last mile, who have not been included for so long. And so the agenda was to actually make it at such a pricing model that encourages inclusion. And so for many countries, the expectation or the hope should be on what is your mandate as a central bank? What is the desire as a nation? Do we want to include people? If we want to include people, we are looking at people who are very poor. The pricing can be either an incentive or an exclusion. Are we ready as a country to absorb that initial cost such that we make it as reasonable as possible so that many of our people become included in this agenda that we wish to have? And for me, I'm really excited about what we've been able to do in Ghana, because as at now, especially also because of interoperability and mobile money operation, we've been able to include over 90% of our adult population to have mobile wallets such that they're able to operate or they're able to be included in financial services, and which is really, really exciting. And so if that is the goal, it also dictates the pace at which a country will go, and it will also inform the model that a country will be able to adopt as well.
No, that's fascinating, and just linking back to the sort of framework that David created in the beginning, it looks that then it is mandated, it is publicly driven. So although it predates UPI, it does follow some of the similar structures. When it comes to pricing, however, it's not free to the end users. There seems to be a standardized price depending on the type of transaction, but it is not free to the consumer. So it is an interesting kind of combination of different components. And to me, like what that raises is a question that we need to always ask alongside the policy objectives around inclusion, around competition, around say moving beyond cash. Alongside those, it's not a different question that needs. It's a sort of an underlying question, is like, what is the business model really that we want to design in order to achieve those objectives? Because ultimately we may have some short-term structures that may make sense in the beginning because we want to quickly achieve high levels, rapid levels of inclusion. But over the long term, of course, there will be some consequences that maybe have a negative effect or have different effects from what they're originally meant for. So to me, if instant payments are expected to be free at the point of use, what is the underlying value proposition for banks, for fintechs, for switches? In particular, not just thinking about the larger incumbent banks or those that are, let's say, closer to government and policymakers, but also the newer the fintechs that are just entering the market, that do not have such an ability to influence and be heard when there are industry consultations. To me, like, how do we find those incentives to keep innovating once the system becomes a public good is an open question. And that to me leads to quite directly to Raza, your analysis of what is happening in Pakistan. I think RAST is quickly becoming one of the most ambitious instant payment systems. And your recent report takes a close look and does a really in-depth analysis on what do pricing considerations mean for the design of the ecosystem. Can you tell us more about what your findings are? And thinking about the framework that David created in the beginning, what are your, how does Pakistan sit there? And what are some of the challenges, dilemmas around pricing and sustainability?
Yeah, thank you, Eduardo. I think Pakistan fits the mold quite well. So it is a state or regulator operated payment scheme. You are consumers. For consumers, it is free. The costs of operating the scheme and the sort of infrastructure is absorbed by the taxpayer and via the regulator, again, the central bank, the State Bank of Pakistan. And in that sense, it fits the mold, right, along with Ghana, PIX, and UPI. Where I think it becomes really interesting is that solving or just simply copying and pasting those elements of the way the infrastructure is placed and paid for hasn't solved for scale. And I think that's where we find ourselves today at this pivotal moment in Pakistan, where we're trying to unlock and solve a lot of problems that the economy has, whether it's documentation, formalization, taxation, whether it is removing the ever-increasing amount of cash in the economy with this one silver bullet. So there's a lot of pressure on Rast. But the bigger challenge that we're trying to frame and understand is, how do we ensure that we actually achieve the scale that everyone talks about? And the reality is, it's in the last mile. That's where the FSPs, the banks, the PSOs, PSPs, EMIs, and every other sort of regulated entity that's in the business of financial services really needs to go do that painstaking work of onboarding merchants, driving adoption. And they're not going to really do that unless there's an economic incentive to do so, because they're all profit maximizing entities trying to increase shareholder value. And that's what we're trying to understand, that where do we strike a balance between it being solving for the greater public good, but then also solving for economic sustainability for all actors in the ecosystem, not just the large ones, to your earlier point, that have the ability to earn money on, through deposit income or float income. In Pakistan, what the report effectively says and what our findings are is there is no clear answer, but there is certainly a framework which we should adopt. And to David's points, I think what it recommends is, we recommend that depending on where we are, we should, in the sort of maturity of the ecosystem, we should adopt a evolutionary approach to pricing. Initially, at the nascent stages, there is a need to ensure that there's a diversity and there is a strong incentive for last mile actors to go out and drive adoption of digital payments to merchants that were otherwise, up to this point, considered not to be viable or bankable for these institutions. So that incentive needs to be created. If you don't create that incentive and protect that incentive, you end up in a downward spiral or a race to zero, which means that a lot of these smaller, more dynamic entrants would simply exit the market altogether or never enter in the first place, which leads to a slightly monopolistic situation with the larger banks. And that's, I think everyone would agree, that's not something we never necessarily want to encourage. We continue to sort of struggle with defining exactly where what pricing should be, but what's very clear is that there needs to be this consistent thinking around preserving incentives for all. It's not just the consumers, it's not just the merchants, not the banks. And I think our recommendation has been to instill a floor to ensure that there is sufficient incentive for the smallest players, but also enough incentive for the larger players to go out and really put their money and their weight behind and effort behind acquiring these customers and building these value-added services and achieving the scale required for sustainability.
Yeah, no, that's very interesting, Raza. And maybe a quick follow-up question that I think also I see some question linked to it. You talked about the risk of, let's say, market concentration and or market structure more broadly, about the pricing decisions that are made. One of the sort of thoughts that we've seen or we've heard in the literature recently is essentially to make this case that on the one hand, there's the direct pricing where you can charge for use. And on the other hand, the other opportunity is for banks to basically use the cross-selling opportunity. Let's say a Google may not have a direct interest in making a fee directly from payment, but it may, because then consumers become part of the ecosystem and they may sell them other services. Do you see as these two alternative models as a complete picture of what is out there? Is there anything that you know, to help us think about whether there are other approaches or whether the two make sense and whether they're linked to specific policy objectives?
So I think I think the whole idea of being able to monetize at the periphery of transactions and therefore develop alternative revenue streams beyond pure transactional revenue in the form of MDR or flat fees, it's a seductive idea. The challenge, however, is typically for any of those to really materialize, you need to achieve significant scale. Now, how do you get to that scale without having the incentives in the short term is, I think, the challenge we need to really solve for. To David's point, models should be evolutionary, pricing should be evolutionary. So, achieve scale, remove the floor, or change your pricing interventions or relax them. These are all options that the regulator has. I think what we really need to figure out is how do we get to 0 to 1 first on merchant payments, and then really figure out what do we need to do in terms of how do we sort of continue to scale, but in a way that's sustainable and sort of unlocks innovation.
Thank you. And that's, I think, a very important framing, which is it's a seductive idea, but ultimately scale really matters. And unless there's a capacity to scale, the opportunity to use other sources of revenue beyond MDR, beyond like those fees, are not as straightforward as we've been hearing recently.
Well, yeah. I mean, Eduardo, to David's point, and I'll just state it again, a lot of that achievement to scale in other markets has been brought on by VC money, which has allowed these businesses to scale merchant acquisition and therefore transaction volume to the point where the economics start making sense for alternative revenue streams. But how do you get to that point in the first place in the absence of these large VC funded or other sort of sources of funds to achieve that scale? I think that's something we need to really think about. It's not as simple as just saying, let's just do what Brazil did, or let's just do what India did.
Yeah, indeed. And in fact, I think, previous call, we had this picture of like sort of a Frankenstein approach where we take all the pieces from all the payment systems that we find most attractive, then put them together, but that does not create the best practice in instant payment systems in their design. And so that's one of the risks that we are taking here from learning from all these examples, just taking a piece of them without really thinking how they fit the context. I'd like quickly to get back to you, David, and thinking now that we heard some of the challenges, some of the framing in Ghana and in Pakistan, does that make you rethink, or does that add nuance to the framework they developed and the research that you're conducting on pricing, or largely does it align with your findings so far?
Well, I think it largely aligns, but frankly, it gladdens the heart to hear about, for example, the discussion that Better Than Cash has been helping promote in Pakistan, because it feels like that's a discussion whose time has come and which has often been taken for granted. So frankly, what I've been struck by, Eduardo, is how ahistoric the IPS discussion is. We regard it as an innovation, and yet we ignore the fact we've been through some decades of thinking about pricing of payment instruments, right? The pricing of cash and what that looks like. Raz's institution was founded on this Better Than Cash, the idea of driving out cash, and lots of studies done about that. But equally, there have been studies done around cost of card, and we tend to look down on some of that. That's the high margin stuff we want to get rid of. But lots of lessons about how do you maintain incentives over a complex, diverse ecosystem with differentiated institutions over time, which come to us from that environment. So I think I would say, Eduardo, what I'm hearing certainly sounds aligned, and also sounds encouraging that a next generation of discussions is starting. And my hope is that as we do that, on a national basis, there can be consensus around what are the types of evidence-based to think about, what are the legitimate cost bases. Right now, I don't think there's enough information out there. So I would argue in the case of these publicly driven schemes, there could be a case for greater transparency around things like costs, if that is a big part of the future here. And the work that Better Than Cash has done in Pakistan and elsewhere, I'm aware, I think is a step towards trying to get to where there's more in the public domain for discussion, which can lead to better policy.
Yes, I think Nancy, you also wanted to jump in, yeah?
Yes. Oh, thank you very much. I think listening to two other speakers, I was just moved to want to weigh in on that particular point on incentives as well. And this is me also thinking that it's also very important that we have an intentional regulatory environment. A lot of digital platforms is built on trust. And the more trust that we build, the more we are going to be able to scale. And so participants on that in that ecosystem should be able to get that incentive that will drive the cost of pricing down, because we'll be able to scale up the numbers. And so intentional and policies that can also drive that trust within the ecosystem. For instance, in Ghana, we focused on building a tiered KYC in, because you would not be able to use the same KYC standard for persons that are able to be onboarded during the traditional financial sector, right? And then we look at persons who are beyond the last mile, who may not necessarily have the requisite documentation to go through, the existing KYC and standard. And so it was important that we're able to put in place a KYC in system that will accommodate different categories of our demographics. And then also there should be consumer education, customer recourse, ensuring that there's data privacy and protection, and then market conduct supervision, the role of the supervisor, making sure that we are able to put on a regulatory hat, but at the same time, we are also ecosystem promoters. And once that ecosystem is developed and we all have a shared responsibility and a shared advantage in that, we're able to assist participants on this ecosystem or these platforms to be able to scale. And once they scale, hopefully the pricing will also come down. It becomes more reasonable for the consumers, more so also for the many people who are poor, and then we're able to include them within the financial services regulatory space as well. And so I thought that, and then also one thing that I wanted to chip in very quickly before I forgot was the opportunity to open up and be transparent about the cost of innovation. Innovation is expensive. Somebody needs to bear that cost. But it's also important that we have harmonization and consensus that will lead to all parties involved to be able to, come up with whatever concerns that we have. And together we can be able to create a model that best benefits all participants within the ecosystem.
Yeah, no, thank you, Nancy. I think that's the cost of innovation is a key part right here. And sometimes when we think about some short maximization or optimization of some short-term goals, say acceleration of usage or increased competition, we may not think about some midterm, longer term goals as well, and innovation being one of them, in the sense that yes, one may come at the expense of the other, and there's not one single answer. That's what I'm getting from the conversation, but that needs to be a dynamic conversation that happens where we assess the context. One question I wanted to ask, which David, you, and then I get also, I see some activity on the chat, so I get also to the audience questions. But maybe quickly, I wanted to go around Raza, Nancy, and also David as well. One of the key questions we have is around consultations. As there being a discussion at country level about pricing decisions, about how to price instant payments, or has that been something that's been centralized by some of the stakeholders and imposed on the others? And if that's the case, like, are there mechanisms in place where that consultation can happen in a more meaningful way? And we only have 7 minutes, so I'll ask you to be brief so we can get also into some audience questions. Raza.
Sure, Eduardo. I think one of the key recommendations coming out of our report was the creation of a national merchant payments working group, because what we found as we did hundreds of these stakeholder interviews was that there wasn't really enough of an honest conversation happening between the regulator and the industry on the topic of pricing or incentives. I think given the fact that most regulated entities report, in this case, to the State Bank of Pakistan, it felt like the conversation there was very, very compliance driven, as opposed to a actual discussion of ground realities. And what that meant was that whilst you have these meetings and everything sounds like it's going swimmingly, when they're back at the office, I think you generally see a sense of apathy towards driving this particular use case, because there isn't really an economic incentive. Therefore, it sort of folds lower on the totem pole of priorities. I think the risk of that in any market is that you'll waste a tremendous amount of time maybe even years before the elephant in the room is actually addressed. And that time you don't really get back. And, in Pakistan's case, I would argue we've probably wasted the better part of a year just, due to a lack of clarity on pricing and how to proceed. And is there, given that there's a lack of clarity, how should one particular entity or any entity proceed? And I think, there's a great deal of value in sort of creating these forums, whether it's association or working group or industry collective, which does sort of collect these specific sort of perspectives from all industry stakeholders, synthesizes them, and provides them to regulators in a manner that it can be incorporated into policy. Because when that voice is left out of that policy discussion, inevitably it's not very effective.
Yeah, indeed. That's I think a critical point, and one that I think where more alignment is needed, more discussion as well, because there are different points of view on what you're saying. But I think that generally we need more discussion over like who should be in the room and at what stage. And to me, also a question that is emerging, given now, for example, BTCA's key role in enabling that conversation is what is the role of also other players like third parties in kind of providing the data, providing some advice, bringing in knowledge from external knowledge. To me, that's also a very important role, which often we need to kind of think about more. I also want to move to Nancy with the same question around, has there been a pricing discussion, and who was in the room and who wasn't in the room? Maybe also linking to one point that I see in the chat. I think Jayshree, I saw some amazing back and forth with Jayshree and Bush there. But one that to me is important is there's some decisions around pricing that are sticky, in the sense that if you provide free transactions, then removing that at a later stage may come at a cost because of pressure, because let's say the government's in place gets pressure to continue subsidizing it, or it may come from an erosion of trust. Consumers may say, hey, something that they started using because it was free, now it's no longer free. So I want to kind of add that question around who was in the room with, should we also consider that trust question?
Absolutely. I mean, thank you so much for this question. It's also very, very important. I must say that for us, I mean, the mere fact that the central bank itself went ahead and established a FinTech and Innovation Office to be dedicated specifically for regulating such a space should tell you the tone at the top. And so we are more collaborative than your average regulator. And so you would not see that we behave like a big brother, we're looking down on ecosystem participants, but more at an eye level, to be able to more collaborate and then engage more, leading to shared positive outcomes. And so for us, we are able to have conversations around pricing with participants within our ecosystem who participate on the DPI platform. And so you would know that all our dedicated electronic money issuers, who are the electronic money issuers, our payment service providers, we have an environment where their pricing models have to be approved. They have to be approved by the central. So we weigh in on that conversation. And then also we are able to create a working group together where we have heads of different institutions sitting together and discussing the reality of it, the cost of innovation as against the cost of delivering that service. Who should bear it? What is the reasonable pricing that we can come to? And then usually we are able to come to a conclusion that benefits both sides. It's never really a perfect one always, but it doesn't take away the consent of both sides. And so we as regulators, we sit in the middle, not forgetting our mandate to include everybody as much as we can, offering equal opportunity, but we don't guarantee equal outcomes. But at the same time, also listening to the market participants, our PSPs, our dedicated electronic money issuers, traditional, banks operating on that platform. What are the concerns? What can we do? And then we make sure that we come out with a model that is acceptable, and then we use that as well. And I think I saw Jayshree's question, which is also very, very, very important, also hinging on trust. For us, also, one of our mandates is to ensure that our system is trusted. And so her point as to, offering a service from the beginning that is free, and subsequently we may want to, put in a certain cost element, also may contribute to eroding the trust that we may have built prior. But what we can do there also to be an incentive to cure that potential problem is to continue to engage and educate our consumers. We
Yes.
need to continue to educate, because you see, like you
Thank you,
said,
Nancy.
even the cash that you hold is not free.
I think that that's exactly the point. Yeah,
And
and
if we
unfortunately
want
we
to
are
have
closing
this,
now.
and if
Yeah,
we want to have this convenience of instant payment, we all need to contribute to the pool and make sure that it becomes sustainable.
indeed. Yeah, I mean, a conversation that I think 45 minutes can only touch at a higher level, but I think it's a very important. Also saw your point in the chat, Raza, about pricing down versus pricing up, and I think that's a very important conversation. Thank you so much, David, Nancy, Raza. That has been an amazing conversation. I think that the question around pricing is we've scratched the surface. There's a lot more that needs to be done. One takeaway: who pays is ultimately a policy choice, and one that reflects how a country balances public good, market incentives, long-term sustainability. It's one that we'll have to continue asking and contextualize for each market. Thank you again, and enjoy the rest of Financial Inclusion Week.